Okay, so like we said in the previous video, right? For us to get our gross profit, we said what? We said our sales, we're gonna take the amount from the trial balance, then minus debtors allowances, and then we're gonna get our what? Our sales, right? So you deduct your sales, you deduct cost of sales from sales, right? Then you will get what? Your gross profit. For you to get your other operating income, you add all of your incomes together, then you put the total there, right? And then after that, you say what? You say gross profit, our profit, you add your other operating income, right? The total that you got from adding all of them, you add it to get what? To get your gross operating income, right? And then thereafter, you actually add all of your expenses and put the total here. Then from there, you subtract it from your gross operating income, right? Okay, so let us look at our expenses. The first one is rent expense, right? Remember that you always take the amounts that are on the that are on your left. This amount, you take them from your trial balance, right? So your rent expense, you look at the amount that's on the trial balance, right? Then you add or subtract the amount that's on your adjustment. Usually your adjustments may tell you, there has been an accrued income. So meaning your accrued expense. This means we have not paid this expense for the entire financial year. So if we have not paid this expense for the entire financial year, your accrued expense you are going to add, right? But if we have paid this expense for the whole financial year and we also paid for the next financial year, that amount that belongs to the next financial year that we call what? Prepaid expense, you need to actually deduct it, right? So you actually add your accrued income, your accrued expense, and then you subtract your what? Your prepaid expense. And you should know your what? Your accrued income and your accrued expense, you add them, right, to your income or expense. And then your prepaid expense and your income received in advance, you subtract, right, because they don't belong in this financial year. Then you're gonna get your what? Your rent income. Then for your bad debts, okay? So let us look at what is bad debts, okay? So bad debt is when our data, right, a data which we consider as an asset is when this particular person has gone bad. So meaning they no longer pay. We have tried to reach them, we have tried to call them, we have tried to send emails, statements, and they are not replying. And also they have been declared insolvent. So meaning they cannot pay their debts. So meaning we cannot classify this person who can no longer pay us as an asset, right? So therefore we are going to classify this person as a bad debt, right? So we are going to remove this person as our asset. Maybe they owed us 300 again. So if they owed us 300, we remove this person as our what? As our debtor, and then we are going to add this person as our bad debt, right? So this is where the amount will come from, right? So usually they say what? They say to you, write this particular person off as a bad debt, or this person has been declared insolvent, so therefore write this person off. Or sometimes they may tell you, okay, this person has been declared insolvent and his estate paid only 20% of the total amount that they owe us, so write off the further amount that was not paid, you see. So you're gonna add to bad debts, then this amount comes from your trial balance, you add them together, then you put the total here. Then you have provision for bad debts adjustment, right? For us to have provision for bad debts adjustment under expenses, remember that your provision for bad debts adjustment, you need the difference between the old provision and the new provision, right? So for you to have an expense, remember that what we usually do with the provision is that we make an allowance for the debtor. So meaning if we assume that our debtors are not going to pay, we are going to put money aside, right? Money aside so that if they don't pay, we are able to cover this. Because remember, as a business, we need to pay our expenses as well. So it's more like an insurance, right? So when you're doing provision for bad debts, you need to have your old provision, which you get from your trial balance, and you need to have your new provision. So if your old provision is less than your new provision, this will mean we are increasing this particular account of provision, and therefore this will be an expense. So again, I repeat, if we have to increase our provision, right? If we are increasing our provision, this means we are putting more money aside, and then therefore this will be our expense. So how are we increasing our provision? We are increasing our provision from 4,000, for example, to 8,000. So we are increasing our provision, this old provision, by 4,000. So 4,000 more is placed into this account, means for this difference, it is an expense, it is an increase. So you are going to put that particular 4,000 where? This 4,000, you put it on your balance here, again, here. This 4,000 will be there, here again. And then you're gonna open brackets and show me how did you get the 4,000. You got the 4,000 by saying what? By saying 8,000 minus what? Minus 4,000. So the new provision minus the old provision. Then you have a trading stock deficit, right? So for you to get a trading stock deficit, it's when what? It's when your, for example, it's when your trading stock system, that's from your trial balance, is actually more than your trading stock on hand when we did our fiscal stock take, right? So if your trading stock on the system is more than your trading stock on hand, that is a deficit. But if your trading stock on the system is less, right, than your trading stock on hand, that is a surplus, and that will be an income, right? So a deficit is when the trading stock on the system is more, right? So therefore, you just show me that difference between the trading stock on the system, which was, for example, 78,000, and the trading stock on hand, which is, for example, 77,000. So that 1,000 difference, you put it here. So that will be our deficit. Then you have your insurance, right? So insurance, usually it's actually prepaid again. So like I said to you, your prepaid expense you subtract because they don't belong in this financial year. Then your advertising, right? Your advertising can also be prepaid. You have to actually minus. Then your balance will be here and there. And then your discount allowed. When our creditors, the people that, when our debtors, the people who buy from us, right? When we give them discount, this will be an expense to us, right? So therefore, you need to put the balance here from your trial balance. Then you have bank charges. You need the amount from the trial balance. And then you need to add all the bank charges, your EFT fee, your service fee. You do not add your interest on what? On bank overdraft. You don't add your interest on bank overdraft on bank charges. Then you add your amount from the trial balance, then you add your amount, the amounts from the adjustments, then you get your balance. Then you have your sundry expense. You also, this expense, you put the balance there from the trial balance. Then you have salaries from the trial balance. Remember again that at the end of the year, we may find that, you know what, we forgot to add this particular person's salary. So if we forgot to add the salary of a person, you add their gross salary here again. And then you add this amount from the trial balance and the salary that we forgot to add, the cross salary. The cross salary, remember, is the salary before deduction. You add them together, then you put the balance there. Then you have your stationery. You remember that for stationery, we need the amount from the trial balance, and then you have to subtract the stationery that we did not use. The stationery and the packing material that you subtract that we did not use, the unused one, will be an asset of the next financial year. So this means they will be used in the next financial year. And in this current financial year, we are going to call them what? Consumable stores on hand. So this consumable stores on hand, it is the stationery and the packing material that we did not use at the end of the year. So we only want the used, right? So you minus the unused from the amount from the trial balance, right? And then you get the balances there. Then you have your depreciation. You calculate depreciation on the sun for the vehicle, for the equipment, then you add all of them together, then you get the amount for your depreciation. Then you have your UIF contribution, pension fund contribution, medical aid contribution. This is the owner contributing, right, for the what? For the employee, right? So I contribute, he contributes. But what Mr. Sibisi contributes, we call it a contribution. But what I contribute, we call it a deduction. So this is the business contribution or the owner's contribution, right? And the owner's contribution, it is an expense, right? So the beginning balances, they come from the what? From the trial balance. Then you add what? Remember again, if we forgot to do what? To add this particular employee at the end of the year. So the contribution for only this employee, you're going to put it here for UIF, for pension and the medical aid, and then you add with the amount from the trial balance, and then you get the particular balances. Then you have your telephone. Your telephone, usually for telephone rates and taxes and water and electricity, what they usually do, they don't pay them at the end of the year. So meaning in a 12-month period, we might have only paid this 3 for like 7 months. So the other one that was not paid, for it to make it 12 months, we call it an accrued expense. And accrued expenses you need to add. So these amounts come from the trial balance, and then these are your accrued expenses that you need to add so that this can be 12 months again, because we used water and electricity for 12 months, so we need to pay for 12 months, and according to the matching, then you get the balances. So after doing all of your incomes, right, you add all of your incomes together, then you put the total here, right? Then after putting the total here, you say what? Your gross operating income minus your other expenses, your other operating expenses. And you know, expenses, they decrease our what? They decrease our profit. So that's why you subtract. So when you say gross operating profit minus operating expenses, you get what we call operating profit. Here's our operating profit. Then you get your interest income. Your interest income, key interest from overdue debtors, the interest that we get from our debtors. You get your interest on current account that we receive from our bank account, that we received on our savings account, and the interest that we get from our fixed deposit. You add all of the interest together, and then you put the amount here, or you add them here where the teacher can see them. Again, you add them there. And then you have, so when you say operating profit plus interest income, you get your profit before interest expense again. So here's your profit before interest expense. Then you have your interest expense. Okay, interest expense here, how I had forgotten about it. So it's your what? It's your interest on overdue creditors. So meaning the interest that we are charged by our creditors for not paying on time. You add your interest on loan, then you add your interest on bank overdraft. Again, you add all of them together, then you put the amount there, or you add them here, and then you put the amount there. So therefore, you deduct your what? Your profit before interest expense, you deduct it from your interest expense, you get profit for the year, right? So therefore, that's your what? That's your income statement. You get profit or you get loss for the year, right?